Welcome to my dear students. I am Mr. Ganeshan K, Assistant Professor of Commerce, Subject Corporate Accounting, Topic Profit Prior to Incorporation. In this session, I am going to solve problem on Profit Prior to Incorporation, which involves preparation of Profit and Loss Account and Balance Sheet as per Companies Act 2013. The Lucky Private Limited was incorporated on 1st July 2007 with an authorized capital of rupees 5 lakh in equity shares of rupees 10 each to take over as a going concern as from 1st April 2007 the existing business of Balu Brothers. The agreement for taking over provided that all profits made from 1st April 2007 should belong to the company. The purchase consideration of rupees 2 lakh together with interest at 8.75% per annum was satisfied on 1st October 2007 by the allotment to the vendors 17,500 equity shares fully paid and the balance in cash. The trial balance of the company as on 31st March 2008 was as follows. Share capital 2,25,000, freehold land at cost 25,000, building at cost 65,000, furniture at cost 7,500, salaries 12,000, purchases including stock taken over 4,85,000, sales including sales prior to incorporation rupees 75,000, 4,50,000, sundry debtors 45,000, sundry creditors 30,000, rent received 6,000, rates and taxes 3,000, repairs 1,500, directors fees 1,200, miscellaneous expenses 7,200, interest to vendors 8,750, cash in hand 1,800, cash at bank 48,050, total 7,11,000. You are required to pay the profit and loss account of the company for the year ended 31st March 2008 and the balance sheet as on the date after taking into account the following adjustments. Stock on 31st March 2008 rupees 1,45,000, bad debts rupees 500 including rupees 200 out of book debts taken over from the vendors to be written off, provision for doubtful debts to be made at rupees 2,500, depreciation on building by 5% and furniture by 10%. Anyway, in this problem, though the problem is related to the earlier previous year, but in spite of that, we are solving this problem based on the Companies Act 2013. So first step, calculation of what? Time ratio. Second one, calculation of what? Sales ratio. Then we are calculating even revised time ratio. Revised time ratio is required for discharging what? Purchase consideration. The business was acquired on 1/4/2007 but incorporated on 1/7/2007. From 1/4/2007 to 1/7/2007, 3 months. And from 1/7/2007 to till the date of closing the books of account, that is 31st March 2008, 9 months. So time ratio will be 3:9, which will be 1:3. Sales ratio, total sales given in the problem 4,50,000. Pre-incorporation sales stated in the problem is what? 75,000. So 4,50,000 minus 75,000. Getting what? 3,75,000. 75,000 is to 3,75,000. Sales ratio 1:5. Then we are calculating what? Revised time ratio based on number of months from during pre-incorporation period, that is 1/4/2007 to 1/7/2007, and from 1/7/2007 to the date of discharge of PC, that is 1/10/2007. So it will be 3:4. The revised time ratio is 3:4. Now we are preparing what I can say profit and loss account. First of all, the profit and loss account, as per the provisions of Companies Act 2013, we must take revenue from operation. Revenue from operation is nothing but what? Sales. So okay, sales is apportioned based on sales ratio 1:5. 4,50,000 total sales. Pre-incorporation sales 75,000. Post-incorporation sales 3,75,000. Then in the other incomes we are having rent received. Please you go to the problem. So in the other incomes we are having rent received 6,000. So this rent received 6,000 should be apportioned based on time ratio. That is 6,000 into 1/4, 6,000 into 3/4. Then we are having what? Cost of materials what? Consumed. So at the cost of material consumed, how to calculate cost of material consumed? Purchases less closing stock, cost of material consumed. Purchases 4,85,000, closing stock 1,40,000. Then cost of material consumed will be 3,45,000, which will be apportioned based on what? Sales ratio 1:5. 3,45,000 into 1/6, 3,45,000 into 5/6. Then under employee benefit expenses, we consider salaries, which is computed based on what? Time ratio, that is 1:3. Total amount is what? 12,000. 12,000 into 1/4, 3,000. 12,000 into 3/4, 9,000. Then under depreciation and amortization, we are having depreciation on building. We are having depreciation on building and depreciation on furniture. So our building value, so we must concentrate on building value 65,000 and on furniture 7,500. So we must calculate depreciation for these two values. Okay, now depreciation on building 1:3 time ratio, depreciation on furniture 1:3 time ratio. 3,250 is the total depreciation. 3,250 into 1 by 4, 3,250 into 3 by 4, 750 into 1 by 4, 750 into 3 by 4. And the finance cost, we are supposed to calculate the interest on PC, which comes to around 8,150, 8,150 into 3 by 7, 8,750 into 4 by 7. And other expenses, we have rates and taxes, okay, time ratio, repairs, time ratio, directors fees, post incorporation, miscellaneous expenses, time ratio, bad debts, actual, provision for the doubtful debts, sales ratio. That is, we know time ratio is what? 1:3, and even we know sales ratio is what? 1:5. All these expenses, whatever we have discussed right now, will be apportioned based on, in case of fixed expenses like rates and taxes, repairs, okay, and repairs and miscellaneous expenses, based on time ratio. Whereas in case of bad debts, okay, or provision for doubtful debts, we are considering sales ratio. Now we are preparing what this revenue account. Okay, so revenue from operations 75,000, 3,75,000. Other incomes 1,500, 4,000 what? 500. Total comes to 76,500, 3,79,500. Then we are having cost of material consumed 57,500, 2,87,500. As per working note, employee benefit expenses 3,000, 9,000. Depreciation and amortization 1,000, 3,000. Finance cost 3,750, 5,000. Then other expenses 3,792, 12,000, 108. We totaled it. Total expenses comes to 69,042 in case of pre-incorporation period and 3,16,608 in case of post-incorporation. Difference we get 7,458 in case of pre-incorporation, 62,892 in case of what? Post-incorporation. Then 7,458 will be your what? Capital reserve. 62,892 will be your what? The profit which will be transferred to profit and loss account. And then we are preparing what? The balance sheet. Before we prepare balance sheet, we must focus on the working notes forming part of our balance sheet, that is share capital 2,25,000, that is under note number 8. Note number 9, reserves and surplus, we consider capital reserve, pre-incorporation profit 7,458, then post-incorporation profit, net profit 62,882, total comes to 70,350, and the trade payables, we consider sundry creditors 30,000, and the tangible assets, we are having what? Freehold land 25,000, building 65,000, there is depreciation at 5%, 3,250, balance 61,750, furniture 7,500, less depreciation at 10%, 750, balance 6,750, total 93,500, and the inventories we are having closing stock 1,40,000, and the trade receivables we are having what? Sundry tasks 45,000, bad debts 500, balance 44,500, less RBTD 2,500, balance will be 42,000. And finally, under cash and cash equivalents, we are having cash in hand and cash at bank. Cash in hand 1,800, cash at bank 48,050. Total comes to 49,850. Now, whatever the values we get in the working note, that will be substituted as it is here. Share capital 2,25,000, reserves and surplus 70,350, and then trade payables 30,000. Fixed assets is concerned, tangible assets 93,500, and then inventories, the trade receivable, cash and cash equivalents. Total it, you get 3,25,350. Okay, this is about the problem. And you have to practice this problem again and again, and such types of problems will not be as usual in the examination, but still I request you to practice again and again to make yourself perfect. Thank you, one and all.